enhance economic development and investment promotion, although I don't see him, in absentia, represented by my brother Vumbe, the Deputy Board Chairperson of the Reserve Bank of Zimbabwe, and board members of the Reserve Bank of Zimbabwe. Reserve Bank of Zimbabwe Deputy Governors, representatives of the international financial institution, including the IMF, World Bank, AFDB, MEFMI, and Afrexim Bank. Heads of national regulatory bodies, the President of the Bankers Association of Zimbabwe, CEOs of the banking sector and leaders of business associations, representatives of the private sector, academia, and civil society, directors and senior managers of the Reserve Bank of Zimbabwe, members of the media, ladies and gentlemen. It is my absolute pleasure and privilege to welcome you all to the Reserve Bank of Zimbabwe this morning. Distinguished guests, as you are aware, we are gathered here to witness the presentation of the 2026 Monetary Policy Statement by the Governor of the Reserve Bank of Zimbabwe, Dr. John Mshayaban. This monetary policy statement is presented at a time when there is heightened global economic fragmentation and heightened uncertainty. Despite these challenges, the economy is experiencing growth, uptick in most sectors under vastly more stable financial conditions across the board than in the past. And the Reserve Bank remains steadfastly committed to its mandate of ensuring price, currency, and financial stability, critical factors that foster sustainable economic growth. The Reserve Bank of Zimbabwe also continues to engage in conversations with stakeholders as part of its auscultative, consultative, and communicative approach to monetary policy formulation and implementation. This way, the Reserve Bank ensures that monetary policy is robust, evidence-based, and forward-looking. What makes this morning's monetary policy statement particularly different from others is that it coincides with the launch of the new redesigned ZIC banknotes, a symbol of our commitment to continue modernizing our currency, ensuring its convenience, acceptability, security, and durability for our transacting public. Ladies and gentlemen, without further ado, it is my singular honor to call upon the Governor, Dr. John Mshayaban, to present the February 2026 Monetary Policy Statement. Governor, sir, the floor is yours.
Thank you.
Good morning. May I recognize the Minister of Finance, Economic Development and Investment Promotion, hereby represented by Honorable Deputy Minister David K. Mnangagwa, the Commander of the Zimbabwe Defense Forces, General Emmanuel Matatu, the Commissioner General of the Zimbabwe Republic Police, Comrade Stephen Mutamba, the Commissioner General of the Prisons and Correctional Services, Comrade Moses Chiobu, the Director General of the President's Office, Dr. Fulton Mangwanya, the Deputy Board Chairperson of the and other board members here present, members of the Monetary Policy Committee here present, and I must say, if you don't agree with anything that is in this monetary policy statement, you blame them. They are seated in that corner there. Reserve Bank of Zimbabwe deputy governors and directors, representatives of international financial institutions. I see the World Bank, IMF, AFDB, MEFMI, Afrexim Bank, the immediate past president of the Bankers Association of Zimbabwe, I see you, CEOs of banking institutions, and all stakeholders that we consulted as we prepared this monetary policy statement, members of the media, ladies and gentlemen, welcome. Today's monetary policy presentation is under the theme, Deepening Currency Usage to Consolidate Price and Exchange Rate Stability. Deepening domestic currency usage to consolidate price and exchange rate stability. And I think this will become more clear as we launch the new Big Five, Big Zig banknotes. We are meeting at a time when the situation on the ground is looking good. We have managed to reduce annual inflation from a high of 95.8% in July 2025 to single-digit levels of 4.1% in January, and only yesterday we got the February inflation figures at 3.8%. So we are now firmly in single-digit territory and in line with the SADC benchmarks of 3 to 7%. So for the first time in many, many years, we can stand and say we are operating in line with the SADC benchmarks. We have also managed to grow reserves from 0.18 months when I took over in April 2024 to 1.5 months of import cover as of 31 December 2025. We also, as we promised in my maiden monetary policy statement, have ensured that at any one time, reserve money is fully backed by reserves. And we have also managed to contain growth at inflation neutral levels. As regards foreign currency, we have continued to generate significant inflows of forex. Last year we did in excess of 16 billion US dollars. And arising from that, we are seeing a situation where there are no outstanding invoices to be paid when it comes to payments that we have to make externally. We have also managed to increase the demand for ZiG from less than 20% in 2024 to between 35 and 40% for electronic transactions as we speak. The banking sector has remained very stable. We have not seen any troubled bank in the market. And as regards our cooperation with the Minister of Finance. I'm pleased to say to you that we meet regularly. In fact, myself, the Minister, and the Permanent Secretary for Finance meet every week. So there is no basis or cause or need for any friction between the two parties. I'm going to present this monetary policy statement in two parts. The first part is going, first of all, to look at what we have managed to do, what did we promise you in 2024, and how have we fared when it comes to those promises. And then I'll come up to the measures that we are introducing in this monetary policy statement. And then the second part will involve the launch of the new ZIG banknotes, which are of very good quality, as you will see. As the central bank, one thing we said we wanted to do was that we should communicate. And in coming up with this monetary policy statement, we engaged in a survey to gauge from the public what they think of the ZIG currency. We also held extensive stakeholder consultations. We met with CZI, we met with ZNCC, we met with the CEO Roundtable, we met with the Consumer Council. We even met with the former governors and deputy governors so that they also give us their piece of their wisdom. Because as you know, former governors are not supposed to publicly comment on what is happening. But we took it upon ourselves to bring them here and say, in the privacy of the central bank, tell us what's and all, what you think of us. And they told us. And some of their input is in the monetary policy statement. So, in April 2024, we said we wanted to achieve 4 things. First, we said we wanted a stable national currency. We also said we wanted a stable exchange rate. We wanted to see macroeconomic stability. And we wanted to foster an environment of policy credibility. And in trying to achieve those, we adopted a hybrid monetary policy framework with reserve money as the operational target and the exchange rate as the intermediate target. This recalibrated monetary policy framework has served the country very well in effectively restoring price and currency and exchange rate stability. So, to achieve those 4 pillars, we said we wanted to see a market-determined exchange rate. And in so doing, we introduced the willing seller, willing buyer foreign exchange arrangement. It has served us well, and as you can see from the graph there, we saw a gradual and significant reduction in the parallel market exchange rate. We saw the willing buyer, willing seller exchange rate stabilizing and oscillating between 25 and 27. And we have seen a significant reduction in the parallel market premium. We also said we wanted to introduce an efficient and optimal money supply management. And we did that by setting targets as to where reserve money would be at the end of each year. And as you can see from that graph, we have managed to live within those targets. The tight monetary policy that we introduced resulted in us reviewing the policy rate from 20% to 35% in September 2024, thereby curbing inflation and exchange rate pressures. We also set for the market what we call the optimum liquidity level, based on the historical transactions that they are transacting on a monthly, daily basis. And as you can see from that graph, the market is continuously traded within the optimum liquidity levels. I know people have said there isn't enough liquidity in the market, but as you can see, while we set the optimum liquidity at that high level, banks have not been able to exhaust that limit. We have also seen a significant decline in money supply growth, declining to as low as 2.7% in 2025 compared to over 40% that we saw in prior years. And on the inflation front, as I said earlier on, the achievement has been quite remarkable. You can see the significant steep decline in the rate of inflation from when we started up to where we are today at 3.8%. In April 2024, we also introduced the new structured currency, ZiG. And what we have noticed is that it has been widely accepted in the market, but the challenge has been on the quality of the notes. The market is saying improve the quality of the banknotes. On reserves, as you can see from the graph that is going to be shown just now, our total reserves are actually exceeding the total ZiG deposits in the market by 2 times and covering reserve money by a lot more. On the governance front, my board members here will confirm that we have introduced new board committees to ensure that there is increased oversight on the operations of the central bank. We also reactivated the Liquidity Management Committee, which is a committee comprising of officials from the Ministry of Finance and officials from the central bank, and arising from that coordination, you would have seen that we have managed to achieve zero lending to government because we are anticipating cash flows as they occur and take appropriate measures to ensure that the government does not have to come to the central bank for accommodation. In terms of monetary policy effectiveness, we have continued to maintain the zero credit arrangement to government. And you will see in NDS2, we have reduced the maximum amount which the Treasury can borrow from the central bank from 20% of the previous year's collections to 5% of the previous year's collection. But even then, the Deputy Minister here is here, and the Minister is always on record for saying they have no appetite to come to the central bank for accommodation. And he's here to confirm that. In terms of other measures that we have implemented, we have ensured that communication becomes one of the tools we use in the central bank. And you would have seen that once every quarter, we give you figures of where reserve money is, where broad money is, where the exchange rate is, where our reserves are, so that we walk the talk together with you. Now, the table that you are going to be seeing that just now is very interesting. It tracks all the metrics where we are saying ZiG month-on-month inflation. You see that for the past year, it has averaged almost 0 to 0.2%. Annual inflation, as we said earlier on, was sitting at 4.1% in January, now at 3.8%. But the total deposits, ZiG deposits in the market, that is the third line, are sitting at about 21 billion ZiG. Take note of that figure because I will talk about it again later. Non-performing loans in the banking sector, well below the international benchmark of 5%, currently sitting at about 3.47%, which is evidence that the banking sector is not troubled. Reserve money, reserves, the reserves that we have are sitting at about 34 billion ZiG when converted. So you are seeing reserves of 34 billion and deposits of 21 billion. The market position, again, I must reiterate, people have been saying there is a liquidity crunch in the market, but look at those figures. The market has been long to the extent of over $2 billion every day for the past 2 years. So there is no liquidity problem in the market. In terms of our reserves, in US dollar terms, we are sitting on over almost $500 million in our balances at the Fed. Gold, as of January, we are now at 4.2 tons, worth 738 million US dollars. And when you add all that up, our total reserves are 1.3 billion US dollars as at the end of January. If you look at the uncovered position, by uncovered position, we're talking of foreign currency invoices in the market that have not yet been honored. As at the end of January, we're sitting on only $4 million. What that is telling you is that the foreign exchange market is clearing on a daily basis. The willing buyer, willing seller exchange rate, end of January was sitting at 25.5. You can see that ZiG has been strengthening over the past 3 or so months. And again, you find that when I talk about the surrender requirements and the instruments that we have introduced to ensure that the exporters get value for their US dollars. In the past, exporters were saying, we can surrender the foreign currency, but don't pay us the ZiG immediately, because we know that the ZiG is going to go one way. The exchange rate will depreciate. Now they are saying, no, the ZiG is appreciating. We want you to pay us immediately, because we would lose value if you pay us later. So what that is telling you is that there's now increased confidence in the local currency. But I think the most important number that I would like you to see there is the last line, where we are talking of an implied exchange rate. If we were to use the reserves that we have, totaling 34 billion ZiG, to buy back all the ZiG deposits in the market, we could do that at an exchange rate of 14.247. What that is telling you is that the current exchange rate of 25.56 is undervalued. The difference between 14 and 25 is what we call the confidence gap. And that is what we need to address as the central bank. And that is what we've been trying to address over the past 2 years. So, if everything was working well, the exchange rate should be 14.2, not 25. But we are in a willing buyer, willing seller environment. The market has decided that the exchange rate is 25, so be it. So let me now turn to the measures that we are announcing today. First, on the policy rate. We have decided to maintain the policy rate at 35%. You might ask, if inflation was 4.1% in January, 3.8% now, why are you also not lowering the policy rate? The argument is very simple. We need, first of all, to ensure that we have anchored inflation expectations. I always use the example where people should not celebrate too early. If you go to a doctor and they give you medication, most often, after a day or two, you start feeling better. But the medication will be lasting for a week, if not 2 weeks. If you stop taking that medication, when the ailment eventually comes back, it will be more serious than before. So allow us to take the medication as prescribed by the doctor until the time is right for us to start easing. If you look at what other central banks have done, you can see there, we start with the European Central Bank. When the inflation line crossed the policy rate line, they did not also immediately reduce the policy rate. There was a period where they maintained it in an effort to anchor inflation expectations. You see the same with the Bank of England. The blue line is the inflation rate, the red line is the policy rate. Closer to home, in fact, the South Africans did the opposite. When the inflation line crossed the policy rate line, they upped the policy rate to further anchor inflation expectations. And this is precisely what we are doing. We first crossed the line in December when we hit 15% month-on-month, year-on-year ZIG inflation. So we have December, January, February. The Monetary Policy Committee members are here. Maybe at their next meeting, they might think that we have taken enough medication. It's time to start easing. It's up to them. I will not speak on their behalf. But for now, the intention is that we anchor inflation expectations. Therefore, the policy rate will be maintained at 35%. On deposit rates, we have agreed with my colleagues in the banking sector that now that inflation is now down to single digit, we also need to start paying depositors real interest rates. We haven't changed these rates. These rates were set at a time when inflation was above 90%. But now you can see that there is every incentive for an investor to bank. So for ZIG deposits, the minimum which we expect banks to pay for savings balances is 5%. And for time deposits, 7.5%. You can see that at a year-on-year inflation rate of 3.8%, investors will be getting positive returns. For US dollars, savings, 2.5%, time deposits, 4%. Where is year-on-year inflation now? Just under 1%. So again, positive returns. Statutory reserves. When we did consultations, people were saying statutory reserves are too high. They are at 30%. And I always say to them, it's not true that statutory reserves are at 30%. They are at 15%. The reason why we have two figures, 30% for demand deposits and 15% for time savings and time deposits, is to encourage my colleagues, the bankers, to bring in deposits that are going to stick. Currently, we have people who are depositing money today and they want to withdraw it tomorrow because they are getting zero interest from the banks. If banks can attract savings and time deposits, they should be able to lower their statutory reserves to 15%. So the challenge is no longer with us. If banks want statutory reserves to go down to 15%, they know what to do. They have to encourage their customers to save. And when you have money that is on savings and time deposits, you now have a stable deposit base from which you can then do longer-term lending. Because currently, we are seeing banks only extending short-term loans. Why? Because they are sitting on demand deposits. So we are maintaining statutory reserves at 30% for demand deposits and 15% for savings and time deposits. Non-negotiable certificates of deposits are a direct OMO instrument. I don't like them, but we have had to use them because banks are not trading with each other. And so when there is excess liquidity in the market, we've been taking that liquidity from the banks at zero interest and then passing in turn to the bank that wants the liquidity at the policy rate. But banks can avoid that by simply lending to each other so that we don't have to be the intermediary. So we are using a carrot and stick approach here where we're saying to banks, if you don't want your money to be on NNCDs at zero, lend the money to the bank next door. So this measure will remain, even though it's a very blunt tool which we don't want to use. But we are forced to use it because there is market segmentation and banks are not trading with each other. However, having said that, we have said to the banks, maybe they are not investing because the treasury bill market is not that active at the moment. So we have introduced a term deposit which is underwritten by the central bank, which we call the ZIG-denominated term deposit facility. So a bank can avoid having their money swept into NNCDs by placing their money in this instrument, which will be earning interest, and the central bank will be in the market on a weekly basis, and banks that may want to invest in it will invest, and they will avoid having their money taken on NNCDs. The other product that we had introduced last year, which is the US dollar denominated deposit facility, is still there. But we can see that for now, people are not wanting to use it because the ZIG is strengthening. They were using it as a hedging instrument. But now, because ZIG is strengthening, they want to be paid immediately. So there isn't much traction on it, but we are keeping it there in case ZIG moves the other way around. On foreign currency retention, I did mention earlier on that the foreign exchange market is currently clearing. We don't have any outstanding invoices that should be paid for anything that have not been paid. This is as a result of the 30% surrender that we are getting. We have decided to maintain it at 30% because we are seeing an uptick in the price of our commodities. So even if we export the same quantity that we exported last year, we should be able to realize more because the price has gone up. So 30% of a larger figure will be a larger figure, which means the foreign exchange market will still be able to clear. So we are maintaining the export retention or export surrender at 30% surrender, 70% retention. But in the past, we had small-scale gold miners who were exempt from export surrender. If you remember, when I first came in, I said, this is not animal farm where some animals are more equal than others. So we now want to start gradually bringing this in the net. So for now, they are going to have to surrender 10% and retain 90%, and the figure will be reviewed as we go. So it's 70% retention for everyone. For small-scale gold miners, it's 90%. We were also beginning to see arbitrage activities where large-scale gold miners were now marketing their gold as if they were small-scale, via the small-scale, and we want to bridge that. The targeted finance facility was introduced last year as an inflation-neutral way of injecting liquidity to the productive sector. It has served its purpose very well, but I noticed that as of yesterday, almost everyone who borrowed under it had repaid, and I asked why. And I was told, well, everyone was expecting that you were going to reduce the policy rate. So they wanted to repay so that they can redraw at a lower rate. Unfortunately, it hasn't happened. But we are maintaining this targeted finance facility, and in fact, we are doubling it from 600 million ZIG to 1.2 billion ZIG. It has served its purpose. People who have accessed it have been able to use it to bring in raw materials, because when even if you are getting it in ZIG, you should be able to go onto the willing seller, willing buyer market to get Forex to import whatever it is that you want to import. And that pie chart is showing you that at peak drawdown, most of that money went into manufacturing at about 49% and agriculture at 34%. We also later on allowed the retail sector to access it, and they accessed 15% of the targeted finance facility. While I said earlier on that we have an effective willing buyer, willing seller foreign exchange trading arrangement, we have continuously received insinuations from the public to the effect that they think that there is a central bank hand in the determination of the exchange rate. I can tell you that all we do as the central bank is to collect trades that would have been traded by the market every day. We say to this bank, how much did you buy at what rate? How much did you sell at what rate? We do the same to the next bank. And then we calculate a weighted average exchange rate. But the market does not believe us. So we have said, let's remove the manual element to ensure that price determination, price discovery is done in an electronic manner. So as the central bank, we are developing a foreign exchange trading system, which is going to be algorithm-based. You go into that system anonymously with a sell order or a buy order, and your orders will be matched. And only after the orders have been matched will you know who you have traded with, and you settle. This system is currently being developed. Some of the bankers here will tell you that we have involved them in user acceptance testing. They have come back to us with some very useful comments on how we can improve the system. We are working on those comments, and once we have perfected the system, it's going to be subjected to validation by a reputable international organization. I won't mention them, they are here, but we are not just going to say we have developed it on our own and it's okay. We want the system to be validated. And once it has been validated, we'll introduce it and we start trading electronically, and price discovery will be done electronically. So you will be told when the system is ready for trading. The same applies to the publication of daily reference rates. Again, people were not clear as to exactly how we calculate. In this monetary policy, we are just clarifying that we take trades that would have been traded up to the close of trading business, cut-off date, cut-off time, and then we work out the weighted average. But after we introduce this system, we won't be calculating it manually. It will be there, real time. As people are trading, the weighted average will be updating itself. So again, we are removing the manual element in case you think there is a central bank hand in the determination of the foreign exchange rate. We have no interest in determining the exchange rate. It has to be market determined. Now, in our consultations, we also received complaints from the market that the limits for mobile money were now so low that it was pointless transacting. So we have decided to review the ZIG limits upwards. The US dollar limits remain the same, where for person to person in US dollars, per transaction, you can do 500 per month, per transaction, per day, but the limit for the month is 1,000. For P2B, you can do a transaction at 1,000 per day, but the limit for the month is 3,000. That's US dollars. And for ZIPIT, 1,000 per day, monthly limit 3,000. But you see that on the ZIG side, that's where we have reviewed from the monthly limit has now been pegged at 50,000 ZIG, which is approximately 2,000 US dollars. And the daily transacting limit or transaction limit is now about 13,000 ZIG. So we have upped the limits. Now, there has been a lot of talk about ease of doing business, and we must appreciate what government has done. They've slashed charges for almost everything that the government is doing. And so we felt that as the central bank, we must also follow suit. We can't talk about ease of doing business only as it pertains to government, and we say we are not touched. As the central bank, we provide the RTGS system to the banks, and as you can see from there, we have reduced the charges that we charge to the banks by 11%, almost across the board. So us having done that, we then sat down with our colleagues in the banking sector and said, you know, the rest of the economy is trying to improve the ease of doing business. What are we doing as a sector? So there was a letter which was being circulated on social media where I wrote to the banks and said, let's have your suggestions. They came back to us and they said, we have heard you. As you are aware, we are in the process of digitalizing our systems. And as we digitalize, we are reducing the cost per transaction, and we should pass it on to our customers. So here is what they offered. And I think we must applaud, because this is the first time that the bankers voluntarily said, no, we also need to do something. Last time, they agreed that $0 to $5, no bank charges. Any transactions between $0 and $5. And then they agreed that any balances below $100 or ZiG equivalent, there would be no service fees. But they've gone further. And they've said cash withdrawal fees, I think it was going at anything 3 to 4%. They've said the maximum should now be 2% for cash withdrawal. That's a massive reduction. They've also reduced point of sale charges, and the maximum is now 1.5%. Again, these charges were going up to 3%, and they've pegged the charge per transaction at $20. They have removed the balance inquiry charges. In fact, I said to them, I said to them, well, this is, I don't think people will applaud that. Because I go to my bank and say to them, how much do I owe you? I want to know. And they charge me for asking so that I can pay them. So they said, no, there is no more charge for balance inquiry. The same with cash deposits. They used to charge cash deposit fees, but now they've scrapped that. When you deposit cash, if you deposit your $100, it will be $100 until you want to use it. And on bank cards, all they are doing is, what they charge you is the cost of renewing that card. They're doing it on a cost recovery basis. If their supplier says it's $1 a charge, a card, they will charge you $1 a card. I think the banking sector deserves a round of applause. And arising from this, they are going to see more and more people wanting to open accounts. Because remember, on the savings side, they are going to pay real interest rates for deposits, and then the bank charges have been reduced. So no more vaults, no more mattress banking. The banks are open for business. Now, we have a serious problem with the mobile network operators. I think about 2 weeks ago, you may have read in the press where some boys in Chitungwiza were found with 50 SIM cards each. And each of those SIM cards is a wallet. Obviously, those are ghost accounts. Some of them, when the police now try to trace to say, this fraud happened, who was the perpetrator? They hit a dead end because the account that was used to receive that money belongs to a deceased person. So we are ordering MNOs that before the end of June this year, they must have, with the assistance of the Registrar General, screened all their accounts and eliminate any account that cannot be validated by a valid ID through the central registry. And the central bank is going to audit that by the end of June. We cannot have an environment where people are laundering money through ghost accounts. That we will not allow. So they must, with immediate effect, start cleaning up their databases. Secondly, when the bankers agreed to charge no fees for transactions between $0 and $5 or ZIG equivalent, the MNOs thought they were not banks. They want to be banks when it suits them, but they don't want to be banks when it doesn't suit them. So this 0 to 5 free of bank charges is applying to them as well. And we would want the public to let us know if they are charged for a transaction below $5 by an MNO, they should let us know, and we would draw that license for that MNO to offer services. Then, still on the MNOs, we have noticed that MNOs are issuing what are called nano loans. They say, oh, when you run out of airtime or when you want something like for $10, just dial this star hash and we'll give you the loan. They are creating money. Now imagine a mobile network operator with 10 million subscribers, and they give each one $10. That's 100 million US dollars that they will have created, not banked by a deposit, not backed by anything. And that's money creation. So with immediate effect, all these nano loans must be underwritten by a commercial bank. They must be sitting on the balance sheet of a commercial bank, and the central bank is going to audit that. Now, the issue to do with what used to be year 2030 when it comes to the use of monocurrency. We want to restate that from where we sit at the central bank, and also from the ministry side, I can speak on their behalf on this one. We are not talking about 2030 anymore. We are talking about conditions precedent for us to achieve monocurrency. And these conditions precedent are, first, we must have durable economic stability characterized by low and stable inflation at single-digit levels. So where are we now? We had single-digit in January, single-digit in February. But as I said earlier on, it's too early to celebrate. We want to sustain that over a period of time. But we can partially tick that box because we are on the road to achieving it. But I don't think, based on 2 points, we can say we are now ready to go for monocurrency. So we are not ready. But is it possible that if we sustain this for 2026, 2027, 2028, is it possible that we could go monocurrency in 2028? Well, why not? But as we said also, this has got to be market-driven. You find that when you go into monocurrency, you won't be told. You are the ones who will be indifferent as to whether a person pays you in US dollars or ZIG, you won't mind. But it will only happen if we achieve these CPs. The next CP is that we should have 3 to 6 months of import cover as reserves. Currently, we are sitting on 1.5 months. Are we there? Not yet. Therefore, can't talk of monocurrency now. But at the rate at which we are building our reserves, if we did 1.5 months in less than 2 years, there is a very good chance that we could do 6 months in another 3 years. I'm trying to say 2030 might come before or after 2030. We don't know. But as long as we have got these CPs under control, there will be no challenge in introducing a monocurrency. We also said we need an efficient foreign exchange management system that eliminates foreign exchange market segmentation and promotes ease of access to foreign currency by importers and for other bona fide requirements. Currently, we do have a system, but I'd say it's not deep enough. We need to then bring in this new system, also get more people selling money on the willing seller, willing buyer market, and then we can tick that box. We said we want stable exchange rate dynamics with minimum over or undervaluation of the ZiG. Yes, we are currently enjoying that, but the premium is still a bit too high for me. It's just under 20%. Maybe once we manage to reduce it further and we continue to have the stable exchange rate, we can tick that box. Increased demand of ZiG through recalibration of the percentage of government taxes and broadening payment of public goods and services in local currency. Government currently said 50% of your tax is payable in ZiG, 50% in US dollars, or if you are paying more if you are receiving more ZiG, you pay more tax in ZiG. It has worked. We are seeing situations where at QPD, corporates are running around selling foreign currency to get ZiG. But we have said to these corporates, it's not necessary for you to do that. If you sell some of your products in ZiG, you will not be running around looking for Forex on QPD. Because when you sell Forex to the banks, the bankers are here. They'll buy it from you at the buying rate, which at the moment is 25 point something. But when you are selling your product, we said you are free to sell it at an exchange rate of your choice. You could have sold your product at an exchange rate of 30. So if there are any corporates who are here, who are listening, take it from me. Start selling some of your products in ZiG so that you don't have a problem at QPD. But as we go towards monocurrency, the ministry will be reviewing the percentage payable in ZiG until maybe we'll get to a situation where they will say, we don't want any US dollars, you pay us in ZiG completely. And when that happens, it means you are also 100% local currency. We said we want financial sector stability is there, so that box, if that were the only CP, we would be in monocurrency today. As an efficient national payment system, we have got that. And fiscal and monetary cohesion, no financing of budget deficits. We've been doing that for the past year and a half. So we have already ticked some of the boxes. But what it means is that, what do we mean when we say monocurrency? When we get there, it means that all domestic payments will be transacted in local currency. If you go to a shop wanting to buy bread and you've got $1, the shop will tell you to go to the bureau to change next door, change your dollar into ZiG, and then they'll sell you bread. That's what we mean. But what don't we mean? Any contracts that are denominated currently in US dollars will continue to be denominated in US dollars. I know some of you have benefited in the past. When we did the 1:1, someone had borrowed $1 million US dollars, it became $1 million Zimbabwe dollars, and ultimately became nothing. It was paid for them by inflation. This time round, it's not going to be like that. If you borrow in dollars, you are going to pay in dollars. If you have a contract in dollars, it's going to run in dollars. If it is in yen, same story. Anyone who is a holder of an FCA will continue to have their FCA. You are the one who will decide when you want to change your currency. Because if you are going to buy bread and you've got $100 in your FCA, the shop will not allow you. They will want you on the VFX, are not affected. It's a US dollar stock exchange, and it will continue to be a US dollar stock exchange. So you may ask, if I have borrowed $1,000 from the bank, and we are now in monocurrency and my salary is now ZiG, how am I going to pay that US dollars? you'll be allowed to go on the willing buyer, willing seller market to buy enough money for you to pay your installment for that loan. Unless the bank itself says, you know what, today the rate is so and so, just give us this amount in ZIG. It's at the discretion of the bank. So I've heard stories that banks are now restricting the period for which they are lending and so forth. There's no need for that. Because first of all, if you are going to restrict the period, now that we don't know the date for monocurrency, are you going to lend for 1 day? What if tomorrow monocurrency comes? So I think that question is now answered. Now, you also be aware that we reached a staff level agreement with the IMF on a 10-month staff monitored program. I must say that, because I have listened to social media and some of you talk, the IMF did not prescribe to us what should be in the SMP. We told them what we are doing, and they are going to be monitoring to see if we are doing what we said we are doing. And if you look at the structural benchmarks that they have given us, improve foreign exchange market efficiency, that's exactly what I was talking about. That's what we are doing. And they are just going to monitor to say, are you doing what you said you are doing? They want us to promote the increased use of ZIG. That's exactly what we're saying by saying 50% of QPD, is it going to be 70%, 100%? They are just going to be monitoring to see if we are doing what we are doing. So if we fail this SMP, don't blame the IMF, don't blame anyone, blame us, because we told them what we wanted to do, and then if we don't do what we said we were going to do, whose problem is that? They have also said we should continue accumulating reserves. That's exactly what we are doing. We are at 1.5 months now. This year, we want to end at 2 months, if not more. And they are just going to say, are you doing what you said you are going to do? They said, continue with your prudent monetary policy management. That's exactly what we've just done today. When we said we are not moving the policy rate yet, that's what they expect us to do. And they said, strictly adhere to reserve money targets. That's exactly what we've been doing. So I'm just saying to you, let's not read too much into the SMP. They are trying to monitor us so that they can confirm to the rest of the world that we are now as good as any other country. Then, today we are also going to be introducing the Big Five ZIG banknote series. As you know, we are allowed to issue banknotes in terms of the Reserve Bank Act. But I need to tell you that, because some of you have been saying, oh, they are now printing money. The cash that we are printing is substituting electronic money. When banks come to us to get this money, they are coming to exchange their electronic balances that are in their account at the central bank, and then they get the ZIG cash. But maybe before we get to the actual features of the currency, I just want to maybe just walk you through what we think is the economic outlook as we get to the end of the year. You know, we had a very good growth rate. Last year we had said we were going to grow at 6.6%, but the minister here will tell you that they are already in the minutes talking about anything above 8%, which means we have done well. But for next year, we are starting on a higher base, and we are targeting 5% growth. We also expect inflation to remain within single-digit levels, and month-on-month inflation is expected to remain below 1%. We expect the exchange rate to remain stable because we are going to make sure that the foreign exchange market clears on a daily or weekly basis. We are expecting a current account surplus of not less than 2.5 billion this year, again, which means there should be no pressure on the exchange rate. As I said earlier on, we are expecting to end the year with an import cover of 2 months import cover. For those of you who want the US dollars to continue, it means we are not yet ready for monocurrency by the end of this year because we don't have 3 to 6 months import cover. So as the central bank, we will continue to walk the talk and continue with the prudent monetary policy stance that we have said we are going to be implementing. So now turning to the notes, new notes that we are introducing, there is a statutory instrument that is going to be promulgated just now. You will see it announced before the end of the day. And that statutory instrument is going to usher in a new series of ZIG banknotes. I must reiterate that these banknotes are going to co-circulate with the existing notes that we have in the system. So we have the 10 and 20 that are in the system. We're going to introduce new notes that are coming in. They will circulate side by side. So banks are required to make sure that they continue to receive the old series ZIG banknotes. When you are in a shop you are buying, if someone brings the new one, it's okay. Someone brings the old one, it's okay. If you get change from a shop and you are given the old one, it's okay. But when that money comes to the banking system, banks are expected to take the old notes, bring them to the central bank, and we destroy them and we give them value in new notes. So the ZIG new series banknotes will start circulating from the 7th of April this year. Between now and the 7th of April, we are going to go on an extensive awareness so that people know the features of these notes. Today, by the 5th of April, we are going to make sure that the ZIG 10 and ZIG 20 notes and ZIG 50 are introduced to the market. So it is going to be ZIG 10, ZIG 20, and ZIG 50. The 100 and 200 are there, but we will introduce them to the market later, and we'll tell you when we are ready to introduce them. Aligned to that, we had also noticed that the market was no longer using ZIG coins. And we have noticed a situation where a combi ride is now said to be for 20 ZIG. But even if you are using an exchange rate of 30, 50 cents should be 15 ZIG. So we are reissuing ZIG coins so that if my combi ride is 15 ZIG, I give you 10 ZIG and a 5 ZIG coin, and I'm good to go. And we are encouraging our banks to make sure that the coins are distributed and are available in the market so that we don't end up with prices being inflated simply because people do not have change. So those are the coins. They are there. They've always been there in the system. We are simply relaunching them. And for the notes, so as I said earlier on the 7th of April, we are going to make sure that all the banks have got 10, 20, and 50 ZIG. On the 10 ZIG, there is a buffalo on the front and the matopo. I think you can, Dr. Mpofu, you can just pass these around so that people can touch and feel them. On the 20 ZIG is the elephant, and at the back there is our new parliament building. And on the 50 ZIG there is a rhino in front and the Lake Kariba at the back. So you can see that we are talking about our big 5 animals, and we are also talking about national monuments of significance. On the 100 Zig, we have the leopard in front and the Victoria Falls at the back. And the big one, 200 Zig, the lion in front and the Great Zimbabwe at the back. So coincidentally, the lion happens to be the totem of our president, but there's no link there. It's just by coincidence that it's the. So we are going to make sure that all bank ATMs have got the new Zig notes. We are going to make sure that every bank and every branch has got the new Zig notes so that we don't have a situation where people are saying we have not seen these notes. Now, having introduced the new notes, we have also taken the liberty to now review the cash withdrawal limits for Zig. Currently, individuals were limited to 3,000, I think, per week, and now we have upped that to 10,000 Zig. And corporates were at 30,000, now it's at 100,000 Zig. But having said that, we are not de-emphasizing the need for us to go digital. Cash is only one other means of payment, and we are encouraging banks to ensure that we up the game in terms of electronic means of transacting, so that we complement so that the Zig cash is just complementing the electronic transactions. In the next 30 or so days, we are going to embark on an expansive and extensive nationwide Zig campaign. We will reach every growth point, every township, so that people are aware of the features of these new notes. So I think on that note, I will conclude my presentation, and then I'll ask Dr. Mpofu and our colleague Dominic to walk you through the security features of the new Zig banknotes. Otherwise, I lay the monetary policy statement before you, and these are the new notes. This is the 10 Zig, 20 Zig, 50 Zig. As we said, these are the ones that are coming in on the 7th of April. Then there is the 100 Zig and 200 Zig that are going to come later. Sorry. Oh, you want to take care? Okay. First.
Just hold on. We take the 50 coming in. This one is one.
Okay. Thank you. Thank you. Thank you.
Can I keep this?